ETFs have been all the rage this year among investors who've gravitated towards the low risk of these assets, which offer passive exposure to a particular index. As of March 31st, 2011, U.S. ETFs had doubled from 2007 levels. Accordingly, index tracking funds have dominated the fund flows in recent weeks. First, these index funds took over business from equity funds, which were already losing money to bonds due to the market's turbulence. Overall, stock pickers in the U.S. have suffered $500 billion in withdrawals since they started losing ground to index tracking funds 5 years ago. Now it seems index tracking funds are replacing some bond fund business as well. In particular, index funds that track bonds have been popular. Passive funds won 39% of all new bond fund money this year, according to Morningstar. That was up from 22% 2 years earlier. Peter Fisher of BlackRock describes this as the second phase of the index revolution. Data from the Investment Company Institute show that assets in exchange-traded funds that track bond markets more than quadrupled since the beginning of 2008 to $163 billion. One likely reason investors are choosing passive funds is the disappointing performance of top fund managers this year. 8 out of 10 bond fund managers have underperformed the U.S. market in the past 12 months. Bill Gross and Dan Fuss are among those trailing markets despite their golden reputations. The shift of money into passive funds indicates that investors are now second-guessing the idea that these managers really add value to a portfolio. And considering the fees these managers charge, those doubts don't come as a surprise. A lower negative return is bad enough, but when it comes at a high price, that really stings. And since yields have fallen overall, making it unlikely that returns will far outstrip any cost of management, lower fees have become more and more important to investors.